Today's top picks from Reuters Breakingviews. BP could be in line for a $30 billion cash windfall, and mixed messages from topsy-turvy markets is actually grown-up asset allocation. With me now to discuss these stories is Reuters Breakingviews' Robert Cole. Robert, $30 billion, the ups and downs of its time in Russia will be quickly forgotten by BP if it can get its hands on $30 billion from the sale of its stake in that joint venture.
Well, no, I don't think so at all. I mean, I think we should remember that there's a big if here in the first instance. If it gets its hand on $30 billion, could be a lot less than that. Now, clearly, its relationship with TNK and with its Russian licence givers it has been a very, very fraught one. There is some relief, I think, in the market that what has looked like a car crash for a long time in that kind of relationship with Russia is beginning to find some sort of resolution. But one if is we're still quite a long way from that resolution. And I can't help feeling that even if they get quite a generous settlement, what are they going to do with the money? Well, they need upstream assets. And actually, Russia has a lot of upstream assets. Are they going to kind of restitch some sort of deal with Rosneft together? Well, good luck with them on that. But one way or another, they seem to have to find upstream assets. They need to find exploration, new finds of hydrocarbon. And yeah, they might be swapping a difficult relationship in Russia for another difficult relationship somewhere else in the world, which just actually, for me, just all goes back to showing what a complete disaster BP has been over the last couple of years.
Sorry to interrupt, but surely, given their experience in Russia with TNK, it might be a case of once bitten, twice shy for BP in that kind of venture in certain parts of the world.
Oh, I'm sure it is, but they've got to put their teeth into these kind of deals because you can't just put down a well in the middle of Canary Wharf and think that oil's going to come out of it in a nice, safe environment. The fact of hydrocarbon geology is that it's getting increasingly hard to find big deposits, and they're in increasingly difficult places run by governments who perhaps aren't as straightforward as one would like. So, but that is the skill that BP has. You've got to remember, it's not a state-owned oil company. It does not own assets. It owns licenses to drill for assets. In that case, its key skill is being able to manage these diplomatic relationships.
So it has to do something with this cash pile.
Oh, well, it has to do something with the cash pile on the assumption that it actually gets it.
Well, this takes us on to our next point, which is asset allocation. You argue that the divergence between equities and bonds is a sign of more mature markets.
Yeah, I think so. I mean, a lot of people, particularly who are looking at short-term movements in markets, sometimes have a rather sort of jaundiced view, it seems to me, of investors' asset allocation techniques. I'm trying to suggest that, far from making investors look silly, markets movements have actually made them look rather mature. So, recap. Bond yields, particularly safe haven bond yields, have crashing through the floor as the rush for safe haven assets amid a great fear of a euro meltdown and US weakness and Chinese weakness comes through. So that seems to send a fairly clear sort of signal of scaredness, risk off. Yet you look at the equity markets and clearly they're not in great shape, but look at them over and they've lost a lot of gains that were made in the early part of the year. Yeah, so they're not in great shape, but over 6 months, they're not in a different place than they were, and that suggests that perhaps people are a little more confident, and there is some possibility of optimism there. Now, you might think, and a traditional view might think that those two things are contradictory, but I'm saying, look, actually, an investor is allowed to have two thoughts in their head at the same time.
Or the relatively good performance of the equity market until now suggests that. It backs up the view that the equity markets are always last to know. If you want to know the real sentiment, the real outlook, you follow the bond market. And what the bond market is saying is pretty clear. It's only a matter of time until equities catch up.
Yeah, it could be that equity markets got it wrong, but I really don't think that's the case. I think the bond market is showing you that there is a great appetite for safe haven assets. Yeah. It's also telling you, of course, that the bond market has finally woken up to the fact that Greek bonds and German bonds don't have the same risk profile. At the same time, I think that, you know, while there's an appetite for safety, there's also some appetite for looking for the opportunities that may be in store if this euro crisis isn't quite as bad as it looks, and resolves itself in a moderately short period of time.
Well, May was a pretty dreadful month. We're at the start of June. I wonder.
Absolutely, but any decent investor should be looking not at May, but at 2029. That's the kind of horizon, and if you're looking at those kind of horizons, you know, there is great value in equities. I'm sure of that.
Okay, time will tell. Robert, thank you very much. That's all for now. My thanks there to Robert Cole. For more agenda-setting financial insight, watch your US Breaking Views show every day at 12:30 Eastern, 17:30 British Summer Time. I'm Jamie McGeever. This is Reuters.